Bloomberg Audio Studios. Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Remember, the Treasury Department notified lawmakers just yesterday that a China state-sponsored actor infiltrated workstations in what, as you've been saying, officials are now calling a major incident. We're going to bring in Jamie Tarabay, who covers cybersecurity for Bloomberg. How do you see what happened to the Treasury Department compared to what we've seen in other hacks that were facilitated by Chinese actors, state-sponsored actors?
It's almost like another day, another hack, quite frankly, at this point. We have been dealing with years of widespread, long-running hacking campaigns, whether they're cyber espionage or pre-positioning in the possible event of a conflict with Taiwan. But we have seen just literally years and years and years of attempts and intrusions and compromises of American and international critical infrastructure networks by Chinese state-sponsored hacking. So this is something that has been happening for years, and the more obvious and the more we talk about these things, the more the expectation is that we expect minimum cybersecurity standards from not just the private sector, but from government agencies, especially one as critical as US Treasury.
What's the expectation as to the defenses of some of these government agencies? Is the belief that the U.S. government has decent cybersecurity defenses or not?
You know, that's a really complicated question because a lot of the time, a lot of these federal government agencies depend on contracts with third-party providers where they have devices that often they're called end of life. So they're routers or they're interconnected devices that basically connect networks together, and they haven't been updated or they are obsolete and they need to be changed. And because bureaucracy and the federal government is so large, it's always a challenge. It always costs money, and it always is a big undertaking. So we are seeing more and more and more of these end-of-life products being compromised. We know more about the fact that these are entry points in a lot of different hacking campaigns. So it's really, we want to see more cybersecurity audits. We would love to see more transparency from federal government agencies about what they're doing in terms of shoring up their systems, using third-party providers, using incident response, using cybersecurity firms, as well as deploying agencies like CISA, the FBI, and other agencies that are concerned with cybersecurity, particularly as we know and has been said repeatedly by government officials for years now that there are Chinese attempts and actions to get into our systems to basically have access to intellectual property and as well as intelligence gathering purposes.
By the way, the Chinese embassy in Washington says it opposes, quote, smear attacks against China without any factual basis. They say the U.S. needs to stop using cybersecurity to smear and slander China and stop spreading all kinds of disinformation about the so-called Chinese hacking threat. How sure are we about this stuff? Because I think it's a huge allegation. It could be construed as an act of war, frankly, hacking the Department of Justice, the Department of Defense, the Treasury. So is it firmly, evidenced that Chinese state hackers are behind this stuff?
I think the phrasing of the letter that Treasury sent to Senators Sherrod Brown and Tim Scott were basically saying that they had denoted it as a major cybersecurity incident, which is what they do when they attribute it to a state-sponsored actor. And the fact that they said that after the investigations by government agencies, the attribution is crystal clear makes it extremely definitive. They would not be putting that in a letter to Congress if they weren't sure. And it would meet the hallmarks and tradecraft of previous Chinese hacking attempt. So there are indicators of compromise. There are tactics and procedures that these hackers would be using that are identifiable to the people who track them. And there are also, companies like Microsoft that have visibility over the internet and watch certain threat actors as they move across networks, and they're able to recognize their patterns of behavior,
Jamie,
as well as the places that they're in.
Jamie, the Treasury Department was notified on December 8th by a third-party provider. They notified Congress on December 30th. So
by the way, ironically called Beyond Trust. You could say that again, right?
Yes.
Yes, that there is an irony to that. But the 3-week lag is what I want to ask about here. Why did they wait so long to notify lawmakers for such an important government body?
That's a great question. We would love to know. And right now we're not getting that information from Treasury. A lot of the times when, particularly this past year, you would have heard about Salt Typhoon and Volt Typhoon, which are extensive hacking campaigns. A lot of the telecommunication companies that have been impacted have not disclosed those hacks because they've been getting waivers on a national security basis that they would have agreed on with the intelligence community, with the government. So if they have not been able to declare or disclose those hacks, it's for myriad reasons, including national security, but also they want to be sure that they know what they have. They also want to probably be able to say that they have eradicated the problem, that they've mitigated any kind of compromise, and that they're able to sort of say, we found it, we've detected it, we're dealing with it, it's over.
Jamie, thanks so much for joining us. Jamie Tarabay reporting on that incident. And it is the one that we know about. There are others, perhaps, that we don't, because Beyond Trust said that a limited number of customers, plural, were involved in this hack. And they also have contracts with the Department of Defense, with the Department of Justice, with the Department of Veterans Affairs. It could be those other agencies haven't gotten back to us and haven't alerted Congress, as far as we know, that they were affected as well. And Paul, as you point out, this really makes you rethink the TikTok issue.
That's kind of the issue I thought about when I was reading the story today. Was, does this put the TikTok issue, which the Supreme Court presumably will take a look at soon, does that put it in a different light for some people? And I suspect it will, because who's to say what's China state versus China private? I don't have a clear understanding of that. And
well, isn't that the same thing?
I think it is for a lot of issues. And
the other thing about this too is the Treasury Department around that time, December 8th, there was a lot of issuance since then. And there was a lot of, wrangling around the debt ceiling and the U.S. fiscal situation.
Yep.
What kind of interference was there? And can they show that there wasn't a significant enough interference to markets? Was there any? It's hard to understand really what the ramifications are from the hack itself.
Yeah, absolutely. I think there's still a lot to unpack here.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Veronica Clark joins us. She's a director of research in the US Economist over there at that little bank on the corner called Citibank. Veronica, what's your 2025 message to your Citi clients about this U.S. economy?
Yeah, I liked the previous discussion of the very bifurcated economy I think that we're experiencing, where lower income people are certainly struggling. Higher income consumers are maybe what is supporting aggregate consumption. But I do think this is a very precarious economy, and that's I think the message for 2025. For our view, it really does come down I think to weakness that we're seeing in the labor market. And I do worry that the Fed has maybe gotten a bit complacent on that labor market weakening. And we do think that this is a Fed that's going to be cutting rates a lot more than markets currently priced in 2025.
The Fed is going to cut rates more than is currently priced in 2025. So you're not worried about policy-driven reinflation next year?
Yeah, not particularly. I think a lot of the fundamental drivers that we've seen of inflation over the last couple of years do look a lot better, even compared to a year ago. Even just this morning, we got Case-Shiller home price data. Home prices are running at a normal pre-pandemic kind of pace. That doesn't seem like a future source of inflation, and that's really where you would see signs of reemerging inflation if rates were too low. We do see the labor market weakening. That means that wage growth has slowed. The labor market doesn't seem like a source of inflationary pressure anymore. I do think there's a lot of ways that we can see something that looks more like 2% inflation in 2025.
So one thing I wonder about a lot, too, is you saw that bifurcation in the economy, and you're kind of already hinting at potential further pains ahead. There was a great point made earlier today by Danielle DiMartino Booth that you might see some of those kind of middle to upper income consumers also start feeling some pain. Some of that pain might be seen as early as the coming days when you look at kind of student loan repayment rates, for example. Housing prices are still high. Cost of rent is still high. I mean, how do you think about that drift higher in terms of the pain that consumers will be feeling into 2025?
Yeah, I do think that's what we've seen, very gradually happening over the last year or so. A lot of aggregate, measures of consumer health really don't look, very comforting. We have the savings rate, which is below pre-pandemic levels and falling. Consumer delinquencies on credit cards, auto loans, they're above 2019 levels. Yes, student loans haven't been counted as defaulted yet, but they will start to be soon. Those do have to start being repaid. I do think the fundamental driver of whether people are going to continue spending is if you have a job or not. And of course, the unemployment rate is still at a healthy level, but it's been trending higher and hiring has been very weak. If we do get to that stage where people are starting to lose their jobs, that I think really would get people to cut back on spending.
What do you think drives that? I mean, what pushes companies to, I guess, if there's no GDP growth, they're not going to need to keep hiring. If there is lower revenue for these big corporations, they won't need more people.
Yeah, I mean, yeah, absolutely. We've had 2 to 3% GDP growth for a couple years, and still the unemployment rate has risen by almost a percentage point from the lows. Hiring is very weak. It's at mid-2008 kind of rates. So we already see that businesses are trying to cut labor costs, and I do think that's a result of maybe trying to offset high borrowing costs. Rates are still restrictive. If people do start to cut back on spending anymore, if that's less business revenue, and you've already been looking for every way to cut labor costs by not hiring or reducing hours, that might get you to layoffs. We've also seen people are not quitting as much, probably for worry of finding a new job. That might mean that lack of voluntary separations might turn into involuntary separations. So there are definitely ways that you can get to that layoff stage.
Given that backdrop, Veronica, how much do you think the Fed could cut? How many times in 2025?
We think 125 basis points. So that's 5 25 basis point cuts. Of course, that's much more than what the market is pricing right now.
So how much then are you worried about the spillover effects? Because we've had investors tell us that, okay, a lot of the assumptions when it comes to stock market projections for next year are really predicated on sufficient growth. But between what you're saying about potential weaknesses in consumers and also what you might expect from the Trump government in terms of efficiency seeking and bond vigilantes just coming after the bond market potentially if the fiscal situation does not improve. All of this put together, does it signal that growth is potentially compromised?
Yeah, I think it does. I mean, we're expecting something like 1% average growth for next year. I do think, fundamentally, if we look back at the last couple of years, I do think rates are restrictive. We've had such substantial fiscal support post-pandemic, and that was the immediate post-pandemic, policies, but also Inflation Reduction Act and infrastructure. And that is going to be fading, in 2025. We'll see if we do get, further cuts to government spending. But that fiscal impulse is flat to maybe negative for next year, and rates are still restrictive. This could be the time that it finally catches up with us.
Well, if they cut down 125 basis points, we're at 3% even on the lower bound, and that should be I would say pretty stimulative. Veronica, thanks so much for joining us. Veronica Clark there is the Citi Director of Research and U.S. Economist talking to us about her expectations for 2025. Happy New Year to all of you.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I want to turn to the big take story on the Bloomberg terminal this morning as the U.S. debt, we've been talking about balloons in the direction of $50 trillion. Treasury bond dealers are warning of the risk of growing market pressures. Joining us now is Bloomberg's Alex Harris, who has more on this story. And Alex, some of the numbers here were shocking even to me, and I cover, this market every day. But Treasury issuance, as one NatWest executive told you, has tripled over the past decade. Meanwhile, the balance sheets of these banks aren't catching up. So being a primary dealer ain't easy these days.
No. And, you look at Citadel in this case, and they had been vying to become a primary dealer for years. And finally in September said, you know what? Thanks, but no thanks. This is just a losing proposition. And I think that's how people are feeling about it now, and why you're not seeing the primary dealer community even grow to keep up with the amount of supply and the amount of debt that the government is issuing. And that's a problem, because you need those primary dealers. You need them to facilitate these, in these markets, from the auctions to secondary market. And remember, their balance sheets for these dealers isn't just treasuries. It's a lot of other things. It's equities, it's mortgage-backed securities, it's asset-backed securities. So you're playing with all these things. And as you can see what happened, if you look back to March 2020, that's a really good example of what happened when the Treasury market ceased to function and dealer balance sheets just could not handle what it needed to do across all asset classes. And that's the scary thing, that it's
Alex,
a regular occurrence.
Maybe let's take a large step back for a moment here, because there are a lot of confusing dynamics that are happening in the Treasury market. One is the size of the U.S. debt load alone. Then there comes the plumbing questions. Why overnight funding seems to hit pockets of stress every so often. The dealer balance sheets being constrained as they are, as you say, and then hedge funds trading with a lot of leverage in this system. What is actually the problem here and the risk in the way the plumbing is working?
So right now what's happening, and where the primary dealers are having problems, is when you're asked to facilitate and intermediate in this market, but you don't have the balance sheet to do it, you have to charge higher funding costs. So that means if you are looking to borrow treasuries, say in the repo market, and you're a hedge fund or an asset manager and you need to borrow to finance securities, you are going to have to pay more. And there might be a point where they are not equipped to pay as much as the dealers are asking them. And so that's when you get backstops and you get, stopping out of positions, and all of that has to make its way back onto the dealer balance sheets. And so that's where they get clogged. And right now there's $400 billion in aggregate treasuries alone sitting on dealer balance sheets. And then every time you get a treasury settlement cycle, so the middle of the month and the end of the month, you're getting a backup in repo rates. It's becoming a regular occurrence, and we're seeing it quite often this year. July, dealer balance sheets were stuck. End of September was a very volatile quarter end that nobody expected. Year end has thankfully been today it's very mild. Repo is under control, but it's because the minute the calendar turned to October, everybody said, wait a minute, we have to be better prepared for this. And so you saw repo rates actually back up to 5.5% in the middle of November, because people said, I don't want to get caught. I got to do this now.
Alex, another question about this too. We're talking about the Treasury market here. It's not only the deepest, most liquid market in the world, it's one of the largest, and it also underpins the cost of every other type of borrowing. And if you're talking about the need to kind of back up rates, as you're talking about in certain parts of the market, at what point does this become a larger issue, even a taxpayer issue?
Oh, well, you can see in some cases it already is. You guys were just talking about interest, the cost of interest in the last segment. That's what it's going to look like to the taxpayer, is that, the auctions are just going to get more expensive, because it's just going to get harder and harder for these dealers to continue taking down this supply. And what's interesting is, remember, the dealer balance sheets are not created equal. So, dealers have the autonomy to decide, where their priorities are. And, during the Treasury refunding one year, I think it was last May, they were doing something called Blue Sky, and they were just kind of kicking around ideas, what they could do to help improve Treasury market functioning. And one of the things they proposed is almost doing a table to see who the biggest dealers were in the Treasury auctions, as a way to sort of light a fire under the rest of the dealer community, to say, hey, if you're not doing your part and you're not pulling your weight, you have to, because there's just too much supply to leave it to a handful of dealers to be taking down. There's only 24 of them. We're down from the peak that we saw in terms of the number of dealers that we saw in 1988. So this is so critical critical that everybody is playing their part in here. And if they're not, there are serious consequences in the terms of costs to the economy, to the taxpayer, and to those just trying to finance their transactions in the financial system.
Alex, it's a great story. I recommend everybody check it out. Treasury's $50 trillion deluge will test strained dealer pipes. And I think that was one of the coolest quotes in the story. Casey Spezzano saying, you're trying to put more treasuries through the same pipes, but those pipes aren't getting any bigger. It's a pretty great way to paint the picture. Alex Harris there with the story on primary dealers. It's our big take. Check it out.
When I was on Wall Street, being a primary dealer was a really good business.
It's a golden
profitable
ticket.
business. Yeah, I mean, when I came on the street in the trading desk, the government bond desk was the bomb. They had so much capital. They could swing it around. They dealt with the...
We could do a whole show on things that have changed since Paul started on Wall Street.
But Citadel Securities really wanted to be in it. They kind of just shelved the plan. That was a huge story this year.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We're going to talk about the food business here because the restaurant business, never easy. Inflation, labor costs, and more budget-conscious consumers are taking a bite out of the industry's profits. Joining us now to talk about how to navigate these challenges and what's ahead for 2025, Danny Grant. He's a 2 Michelin-star chef and partner at Maple Hospitality Group, the company behind Maple and Ash restaurants. You think about some of the challenges that the industry has faced. Let's start with inflation because of course, the cost of certain goods, coffee, cocoa, have just been skyrocketing. Eggs. How do you get around that at a restaurant?
Yeah, well, thank you so much, and Happy New Year to you guys. Thanks for having me on. 2024 has been an incredible year for us, and really had a lot of wins for us in growth and being able to navigate through inflation. And just like probably a lot of parts of the country, we're incredibly excited for what's to come in 2025. We're having the fortunate for a lot of expansion, and we're opening new restaurants in Miami and other parts of the country. So this is a part of our restaurants that we excel the best at is celebrating. So it's one of our favorite days of the year to welcome everybody into the restaurants and celebrate. And to talk about, how we navigate some of the inflation, it's really, we take a lot of the hit on us as far as we look at being able to cover costs and, whether it's coffee to steaks to king crab, and we pass some of that on to the customers, but we also look at very creative ways that we're able to mitigate some of those things by different cooking techniques, different style of service. But one thing that we never sacrifice is the quality of the ingredients. So as you know, the restaurant business is an ever-changing, difficult operating business, but we kind of relish in those moments and have been seeing a lot of success with it.
Talk to us about your consumer. Who is your typical consumer at your restaurants? What are you targeting? Who are you targeting?
Yeah, for us, we like to target a broad span of, we're in neighborhoods and locations that is anything from someone that's looking to come in to have a simple piece of fish and have a beautiful night out, to the much more extravagant celebratory moments of they just closed a big deal and we're the most obvious place to go to celebrate and to blow off all that goes into closing a deal. So, those are some of our target people. We target foodies. We love people that want to eat and drink like the same way we do, because that makes me happy and makes what we do all worth it.
Danny, how has the restaurant staff held up in this post-pandemic world? We continue to see inflation a problem for customers, for diners, and for owners and operators. But what about, servers, bartenders, busboys? Have wages kept up with inflation? How is that part of your family doing?
Yeah, I think that's a great question and a great topic because, without our team, we are not a restaurant. We can't open the doors. And that's one of our most important assets of running restaurants. Some of the things that we've done to keep that in place is, first of all, we have very high grossing restaurants. Chicago Maple and Ash is one of the top grossing restaurants in the country. Wow. That gives us a little bit of extra flexibility to look at ways to be creative and take care of our team. So that we're always looking at upping our wages, health care, and then other things that's, we have food packages that we bring to our team. We do family meals, we do parties, and, other things that just really help keep the morale of the team and everybody feeling together like the tight-knit family that we are.
Great to have you on the program, Danny. Thanks so much for joining us, and we wish you a happy new year and a successful new year as well. Danny Grant, he's a 2 Michelin star chef and a partner of Maple Hospitality Group.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.